If you are looking at your portfolio this morning, just stop. Take a breath. Because if you haven't checked the market since yesterday afternoon, what you're about to see is going to look less like a correction and, frankly, more like a crime scene.
Oh, it is absolutely brutal out there. We're talking about a sea of red that, on the surface, it just defies all logic.
It is Tuesday, February 3rd, 2026. And the financial world is waking up to what feels like a historic hangover. I mean, let's just lay out the damage from yesterday. Silver plummeting 36% in one day.
One single trading session.
It's sitting at what, $73 an ounce right now? And gold, I mean, it just got smashed. It broke below $4,500.
Which, just for context, that wipes out about $1 trillion in market cap in, what, a few hours? It's staggering.
It is. Now, the mainstream headlines, I'm looking at them on my phone right now, they're all saying the same thing. Aggressive profit taking, a technical correction.
The usual story.
But we've been digging through the deep analysis, the flow data, and the latest intel you brought in. And a completely different story is emerging. This wasn't panic, was it?
No. Panic is random. Panic is messy. This was, well, it was surgical. If you track the flow of money, and I mean specifically who moved it and when, this wasn't a correction.
Okay.
The sources we're seeing, they're calling it a dollar strike.
A dollar strike. Wow. That implies intent. That implies it was a weapon.
It is a weapon, a tactical deployment. We are witnessing the opening salvo of a legitimate global currency war. This is not theoretical anymore. It's a clash between two completely different economic systems.
So on one side, you've got this revitalized U.S. strategy, the Warsh dollar, as they're calling it.
Right. And on the other, you have the BRICS unit, a currency backed not by promises, but by, cold hard math and actual metal.
And that's our mission for this deep dive. We have to get past the flashing red tickers and understand the war that's happening underneath. Because by the end of this decade, the world is probably going to have to choose a currency backed by debt or one backed by gold.
And yesterday was the U.S. sending a very clear message.
What was that?
That it is not going down without a fight. The stakes are, and I'm not being dramatic, the entire future of the world reserve currency.
So let's go to the scene of the crime. Take us back to yesterday morning, February 2nd. Before all the red candles started popping up. What was the feeling? Because the charts from Monday morning looked euphoric.
Relatively. Yeah, it was euphoria for what they call the debasement trade. Investors were just betting the U.S. government was trapped, that they had to keep printing money forever to pay the debt.
Right.
So spot silver was trading near, $121? Gold was flirting with $5,600. The whole assumption was the dollar is weak, so buy hard assets.
And then, whim, the floor just falls out. But my question is, how do you coordinate a crash like that? You don't just get a 36% drop because a few guys decided to sell at once.
No, you need institutional leverage for that. You need a trigger.
So what was it?
The trigger came from the CME group. That's the exchange that controls the futures contracts for these metals. And right before the crash, they aggressively, and I mean aggressively, raised margin requirements.
Okay, let's pause right there. For anyone listening who doesn't trade futures, explain margin requirements. This isn't like buying a stock on an app.
No, not at all. Think of it like a down payment on a house. You might put 5% down, and the bank lends you the rest, that down payment. That's your margin.
Okay.
Now imagine you buy $1 million house with $50,000 down, and then suddenly the bank calls you and says, hey, the rules have changed. You need to come up with another $400,000 in cash right now. You have an hour.
And if I don't have 400 grand just sitting around, which I don't,
the bank force sells your house immediately at whatever price they can get. You have no say. They just liquidate you to cover their risk.
And that's exactly what happened to the silver traders yesterday.
Precisely. We are talking about speculators who were leveraged to the hilt. When the margin went up, they had to find cash. Instantly, they couldn't. So the system just sold their positions.
Which starts a cascade.
A liquidation cascade. Selling creates more selling, which pushes the price lower, which triggers more margin calls for other people. It's a death spiral.
And looking at the data, it wasn't just metals. There's a really weird correlation here with crypto. Bitcoin took a massive nosedive at the exact same time.
A massive correlation. We saw nearly $1.7 billion in crypto margin calls.
Right.
And this is a crucial link.
Why?
Because crypto investors, desperate for cash to save their Bitcoin positions, what did they sell? They started dumping their precious metals. It was a fire sale. Anything that wasn't nailed down was sold for dollars.
But why now? Why February 2nd? Was that just random? Or is there a fingerprint on this?
It's never random. You have to connect it to the news cycle. This whole crash happened at the exact moment the news broke about the nomination of Kevin Warsh to the Federal Reserve.
Kevin Warsh, okay, I know that name. Former Fed governor. He's been talked about for years. But why does his name cause a multi-trillion-dollar liquidation?
Because the market sees him as the anti-Powell. He is a hard money guy through and through. His nomination was a signal from the establishment.
A signal saying what?
They're saying, we will not let the dollar die. We are going to crush inflation, and we will crush the price of gold to prove that cash is still king.
It's a flex. It's the empire showing the Death Star is fully operational.
It's a display of brute force, and the goal is to spook every retail investor out of metals. And honestly, looking at the sentiment today, it worked. If you lost 36% in a day, you feel like a fool. You panic sell.
But this is where the research gets fascinating. Because while everyone in New York was panic selling paper contracts, the East, specifically the BRICS nations, they were doing the complete opposite.
They weren't panicking, they were calculating.
Which brings us to the challenger. We've heard rumors about a BRICS currency for years. And to be honest, I was always skeptical. I mean, getting Brazil, Russia, India, China, South Africa to agree on anything seems impossible.
Like herding cats. I know.
Their economies are just so different.
And that's where most Western analysts, I think, really got it wrong. They were imagining a Euro-style currency, something you'd use to buy a coffee. That's not what the BRICS built.
So what is it?
They built a unit of account. It's for global trade. It's a settlement layer.
For tinkers of oil, not cappuccinos.
Exactly. And unlike the dollar, we now have the specific formula. It's not based on faith and credit. It's just math.
Okay, let's break that down because the formula in the reports is really specific and it looks incredibly stable.
It is. So the value of one unit is derived from a weighted basket. And it's anchored, get this, 40% by physical gold.
40%, that's a huge anchor. Why that number? Why not 100%?
40% gives you a hard floor. It means the currency can't go to zero unless gold goes to zero. It's a shield against hyperinflation. But the other 60%, that's the currency basket.
Right.
And it's split equally 12% each among the 5 core currencies: the real, the yuan, the rupee, the ruble, and the rand.
So 40% gold, 12% of each of those 5. What's the logic there? Why mix gold with fiat at all?
It's actually a brilliant design. The gold provides the trust, it protects against collapse. But the currency basket, that provides liquidity and ties the value to actual economic output. Energy, manufacturing, agriculture.
So it's store value from the gold and labor from the currency.
You got it. And we actually saw this thing get stress tested yesterday.
We did? What happened?
This is the key. While the dollar markets were melting down, the unit didn't crash. It just adjusted mathematically.
Because the gold held it up.
And because if, say, Brazil has a financial crisis, it only affects 12% of the unit's value. The anchor holds. It's stable. It's almost boringly stable.
Which is exactly what you want if you're shipping $1 billion of wheat across the ocean. You want certainty, not volatility.
Exactly. The East built a financial shield because they know they can't trust the Fed anymore. So they built a system that trusts math instead.
Which brings us back to the Empire Strikes Back. We touched on Kevin Warsh. So if the BRICS have this gold-backed shield, what is Warsh bringing to the fight? He can't just jack up interest rates, can he? It would bankrupt the U.S. government.
That is the trillion-dollar question. And this is where his strategy gets really interesting. He's coming in as the Neo-Volcker.
Paul Volcker, the Fed chair from the 80s who crushed inflation with 20% interest rates.
The very same. Warsh is cut from that cloth. He's not a Keynesian who thinks you can print your way to prosperity. He looks at the Fed's balance sheet, over $7 trillion now, and he sees a disaster, a subsidy for Wall Street.
So his plan is to pop the balloon.
His plan is to out-hard the BRICS. He wants to shrink that balance sheet, drain the liquidity, and end what he calls the zombie economy. All those companies that only survive because debt is basically free.
But hold on. If you stop printing money and keep rates high, doesn't the economy just crash? I mean, how do you keep the U.S. afloat without the money printer?
This is the biggest gamble of the decade, and it's a theory that's gaining a lot of traction. Warsh is betting everything on AI, artificial intelligence.
Wait, AI? How does ChatGPT save the U.S. dollar? That feels like a stretch.
It sounds like a buzzword, I know, but follow the logic. Warsh believes AI is about to create a massive deflationary wave. Think about it. AI makes code, content, logistics. It makes everything drastically cheaper to produce.
So costs go down because the robots are doing the work.
Right. So his argument is we don't need to print money to get growth. AI will provide the growth. If the Fed just stops debasing the currency, the dollar strengthens, and because of AI, the cost of living falls. He wants to make the dollar scarce and valuable again.
Wow. That is a fascinating thesis. Use tech deflation to offset the pain of monetary tightening. But it's a massive bet. He's betting the farm that the AI boom arrives right now.
He is. And he's willing to let the stock market fall. He's removing the Fed put. He's telling the world, you don't need the BRICS unit. The dollar is backed by the most advanced technology on Earth.
A bold move. But there's always collateral damage when you tighten the screws that hard. You can't just turn off the liquidity tap without breaking some pipes.
Oh, absolutely. And we are already seeing the first casualties of this liquidity vacuum. It's not just numbers on a screen, it's real institutions breaking.
You mean that bank failure in Chicago, the one that broke late last night? Metropolitan Capital.
Yes. And the media is doing the usual thing, blaming bad management. But if you look deeper, Metropolitan failed because the global flow of dollars is drying up.
Walk us through that. Why does a bank in Chicago fail because of a currency war?
Okay, so it's about the euro-dollar system. For decades, dollars have flowed out of the U.S. to buy things, and then they flow back into U.S. banks as deposits. It's a cycle. But as the BRICS nations de-dollarize, paying each other in their own currencies, or this new unit fewer dollars are coming back home, the river is drying up.
And banks like Metropolitan relied on that river.
They relied on that constant flow of cheap overseas funding. When it stops, the holes in their balance sheets get exposed and they go insolvent.
That's terrifying. It shows de-dollarization isn't some abstract theory. It's shutting down banks on Main Street.
And it's not just small banks. Look at the United Nations. The source material highlights a historic funding crisis there. Why? The liquidity is gone. The entire global machine that runs on dollars is grinding to a halt.
That is the real cost of what Warsh is trying to do. The withdrawal symptoms are going to be violent. This brings us to what I think is the most mind-bending part of this whole story, the Great Divergence, the weird anomaly yesterday between West and East that almost no one is talking about.
This is the most critical signal in the market right now. If you miss this, you miss everything. Yesterday, in New York and London, traders were panic selling paper silver, futures contracts.
Okay.
But if you look at the exchanges in Shanghai, Mumbai, or Moscow, they were doing the exact opposite. They were buying physical metal, record amounts.
So we're selling the paper promise, and they are taking the actual bars.
The Shanghai Gold Exchange saw record volumes. Premiums on physical bars, they just skyrocketed. The East sees a price drop to $73, not as a crash, but as a generational entry point.
They're buying the dip on a national scale. The West has the paper, and the East has the gold.
It is a massive wealth transfer. The West sells paper to raise cash to cover margin calls. The East pays that cash to take the physical metal. This is draining Western stockpiles. We are heading for a world with two prices for gold.
A manipulated paper price and a scarcity-driven physical price.
Exactly. And eventually, the paper burns and the metal remains. The BRICS unit is built on that physical price.
So how does this end? Two heavyweights in the ring. The Warsh dollar versus the BRICS unit. Who wins?
The analysis lays out two scenarios. Scenario A is the Warsh victory.
The happy path for the U.S., I guess.
If you can call it that. In this scenario, Warsh succeeds, he shrinks the balance sheet, the AI boom actually happens, and the dollar becomes the hardest currency again. The BRICS unit stays a regional thing just for oil and grain.
Okay. What's scenario B?
Scenario B is the split. The liquidity vacuum breaks too many banks, the economy just can't handle it, the political pressure boils over, and the Fed is forced to pivot. They turn the printers back on.
They blink.
They blink, and the second they do, trust in the dollar just evaporates. The BRICS unit, with its gold anchor, becomes the global safe haven, and the world divides. You get a digital Fiat West, probably running on CBDCs to control the chaos.
Versus a commodity-backed East.
A monetary iron curtain. The unipolar moment is over. The US dollar has a real competitor for the first time in our lives.
It's a sobering thought. So for everyone listening, what's the takeaway here? This feels almost too huge to act on.
You have to ask yourself a simple question. Do you hold the currency of the past, the debt-based dollar that relies on a central bank getting everything perfect? Or do you position yourself for a future with assets that are finite and tangible?
It's about possession.
Wealth is no longer about what can be printed, it's about what can be held. And if you can't touch it, you might not really own it.
That is a thought that is going to keep me up tonight. The crash of February 2nd wasn't the end of something. It was the beginning of the real game.
The clash of the titans has begun. You just don't want to be standing on the fault line when it breaks.
We're going to leave it there for this deep dive. It's a lot to process, but that's why we're here, to try and turn the noise into a signal.
Keep your eyes on the physical flows, not just the paper price.
Always. Thanks for listening, and we'll catch you on the next deep dive.